The home loan crackdown is here. Are you going to have access to less money, and are we going to see property prices fall? Let's discuss it in today's video. My name's Luke and I talk about all things real estate, renovating and financial freedom. And in today's video, we're going to take a look at the home loan crackdown and the announcements by the Reserve Bank and the RBA, and look at what effects these are going to have on the property market. House prices are unlikely to fall next year, even if it becomes harder to get a large home loan, with values instead set to keep rising at a modest pace, economists warn. A clampdown on home lending is likely to come in the coming months. Treasurer Josh Frydenberg backed limits on home buyers taking on more than 6 times their income to debt. So what this is a debt to income ratio. So if you earn $100,000 as an individual and you're looking to purchase a home, the banks are going to look to use a 6 times multiple to limit your lending for investment purchases. So say you didn't own any property and you wanted to make a property purchase, what this might mean is once they bring in these restrictions in the coming months, people are going to need larger deposits and to earn more income in their day job to potentially get into the property market. Now, there's a lot of talk out there about the debt to income ratios. Banks actually allow people like me and other investors to have higher debt to income ratios than a multiple of 6. But if they bring in this limit and requirement, then it's going to really restrict lending for people who are looking to grow a large portfolio. And people are going to have to look at other strategies to potentially manufacture value, increase their incomes to actually grow a portfolio that can give them choices and create passive income. So other measures that could be in focus include reducing the number of borrowers who have small deposits, checking borrowers can repay loans if interest rates are higher. So these are other forms. So if they're looking at the number of borrowers that are using lender's mortgage insurance or have less than a 20% deposit and limiting those as well. And if they're looking at interest rates, they do this anyway, but if they increase the threshold, say they're assessing you at 1.5% over the current interest rate, but say they start assessing people at 2% or 2.5%, that's going to reduce the amount of people that can get access to easy credit. And when that happens, as they restrict credit, this might hurt the growth in the property market. Now, I don't necessarily think that's a bad thing. I think the property market has gone quickly over the last 12 to 18 months, and there's still great opportunities out there in the market. As they're saying, we're not expecting falls in property prices, we're expecting reduced growth in prices. The Reserve Bank on Tuesday noted rapid growth in credit, warning it was important that lending standards are maintained, that loan serviceability buffers are appropriate. After soaring growth in property values over the past year, up more than 20% nationally via CoreLogic's data, economists expect smaller price rises next year due to tighter lending and affordability constraints. Now, they're looking at single-digit growth in 2022 in terms of property prices. So there's still opportunity to ride a bit of this growth wave, but it's not going to be as hot as it has been the last 12 months. Now, we've seen this before. So APRA, Australian Prudential Regulation Authority, restricted share in new loans that could be written interest only in early 2017. So as Sydney and Melbourne were seeing boom periods, the APRA clamped down on lending and restricted the number of people who could use those interest only loans. And that was largely driven by investors. Now, what we're seeing in 2021 and into 2022 is it's not the investors that are really driving the market crazy. It's owner occupiers that are looking for a great place to live and have excess cash after staying at home and saving their pennies and saving their money, who are wanting to purchase and maybe invest in the property market. Now, take a look at this. So Commonwealth Bank, head of Australia Economics, so they do a lot of work, CBA, around economics and property forecasts, Gareth Aird, said that property prices to fall, the likely trigger will be higher interest rates, which the Reserve Bank in its central scenario does not expect until 2024. A potential borrower would be offered less money in the current scenario that they're suggesting by bringing these debt to income ratios, and that's due to this lending clampdown in the next few months. But that in itself doesn't mean the market is going to fall. Borrowers will still be offered a little less, and that will probably take a bit of heat out of the market. So essentially what they're saying here is CBA is going to continue to lend to the everyday Australian, but people are going to have access to less cash. And what that means is less money in the property market and less money to push up prices. The moves should come amid a recovering economy as consumer confidence held up. Many stood down workers are expected to go back to their old jobs as the vaccine rollout takes place, and the housing market has continued to see record high clearance rates in the short term. So So what does all this mean for the property market? And should you be worried about what's going to happen over the coming months in terms of your own lending capacity and potentially property prices around you? Essentially what we're seeing here from the top economists and what Josh Frydenberg is saying is they're wanting to clamp down on lending, and they're looking to do that through debt to income ratios, and they might do it through using higher serviceability buffers in terms of higher interest rate assessments as you look to achieve a loan. But there's only going to be a slight reduction in cash in terms of the amount of cash that you're able to get access to make a property purchase. And that's only going to slow growth. It's not going to stop growth completely, and we're not going to see prices fall in the short term. What we're really looking to here is the horizon of 2024 and what happens with interest rates. I know the RBA has been very strong in holding their firm in their interest rates and looking to keep that cash rate around the 0% mark. And we won't really see an interest rate rise until 2024 because the RBA is more focused on the economy rather than the outcomes on the property market, and they'll look to likely lift the interest rate in the coming years, but not in the short term. So what does this mean for you as the everyday investor, and what are we doing to navigate this scenario and this environment that we're in? Essentially what Emily and I are looking to do at our point in time is to maximize our lending and our leverage and to grow our portfolio to a large point, try and reach that $5 million mark to take advantage of the lending standards as they are currently. Of course, that is taking a calculated risk because interest rates could rise, and we might be restricted in our lending capacity in the coming months based on the changes in policy. But what we're trying to do is take that last big leap in terms of moving towards a cash flow play and grow our property portfolio to give us more choices. Now, there's no risk without reward. So did I say that right? There's no reward without risk. So flip that around. So there's no reward without taking some risk. If you're just going to sit on your hands and not get into the property market at all and not invest your money, you're essentially relying on cash and your savings and your super to give you long-term wealth. And that's okay if that's what you want to do. But if you're looking for more choices like we are, and if you're looking to potentially reach financial freedom earlier, you need to take some calculated risks. So based on all the data that we have, we can see that in the short term, they're going to reduce lending capacity. At 2024, we're going to see potentially interest rate rises. So we need to factor those things into our calculations as we're running numbers, as we grow our property portfolio, and always have cash buffers in place. For us, that means sitting cash in our offset account with our principal place of residence, because that's our non-deductible debt, and using that money, when we've got excess cash to purchase more property, or keep it as a cash buffer to maybe invest in shares or take on other ventures. So make sure you subscribe to the channel as we keep a close eye on lending policy and what's happening in the economy and how that can affect your property investing. If you're interested in seeing more videos on real estate, renovating, and financial freedom, check out this video over here. See you in the next one. Peace.